Most people have no idea that one of the most important financial stories in the world is not happening on Wall Street, but deep underground, inside aging silver mines scattered across Mexico, Peru, China, and beyond. At the same time, governments are printing trillions in debt, central banks are buying gold at record levels, and the world is racing toward electrification. One metal sits at the center of all three trends: silver. And after years of underperformance, silver is exploding higher once again. The question now is no longer whether silver matters. The question is whether the market is beginning to realize just how small the physical silver market really is compared to the scale of global demand now forming around it. Because few people understand the chain reaction that could unfold if industrial demand, monetary uncertainty, and supply shortages collide at the same time. And history shows that when silver moves, it tends to move very fast. What makes this moment especially important is that silver is no longer just a precious metal tied to jewelry or coins. It has become a strategic industrial material tied directly to solar energy, artificial intelligence infrastructure, military electronics, electric vehicles, and the global energy transition itself. Meanwhile, the mining industry has struggled for years with declining ore grades, rising production costs, permitting delays, political instability, and a lack of major new discoveries. In other words, demand is accelerating just as supply becomes increasingly difficult to expand. And behind the headlines, some of the world's largest financial institutions, central banks, sovereign wealth funds, and family offices are quietly paying attention. Because while stocks, currencies, and governments have come and gone throughout history, there are only a handful of assets that have survived every monetary reset for thousands of years: gold, silver, and productive land. Three assets that, remarkably, have never gone to zero in over 5,000 years of recorded human civilization. Here's what we're going to cover today. First, what's really happening inside the silver market right now and why most investors are looking in the wrong place. Second, the hidden supply crisis developing across the global mining industry. Third, why industrial demand for silver is rising far faster than many analysts expected. Fourth, what history teaches us about inflation, monetary instability, and precious metals. Fifth, why smart money and governments around the world are increasingly focused on hard assets. And finally, what all of this could mean for ordinary people trying to protect purchasing power in an increasingly uncertain financial system. Because markets move in cycles, but the forces driving this story may be far bigger than most people realize. Here's what's really happening. Most mainstream coverage still treats silver like a speculative side story compared to gold or equities. But silver occupies a unique position because it behaves as both a monetary metal and an industrial commodity at the same time. Think of the global economy like a machine. Every major system inside that machine, energy grids, data centers, semiconductors, electric vehicles, telecommunications, military systems, increasingly depends on silver because of its unmatched electrical conductivity. Now imagine that machine suddenly requiring more silver every single year while the pipelines supplying it become harder and more expensive to maintain. That's essentially the situation developing right now. The Silver Institute has reported rising industrial demand driven heavily by photovoltaics, electronics, and electrification trends. Solar panel manufacturing alone now consumes enormous amounts of global silver supply. Meanwhile, artificial intelligence infrastructure is increasing demand for advanced electronics and data center expansion worldwide. Here's what most people don't realize. Silver inventories are tiny compared to other major financial markets. The total value of annual silver production globally is extremely small relative to the scale of sovereign debt markets, equity markets, or even large institutional asset allocations. That means relatively small capital flows can have outsized impacts on price. And unlike digital financial assets, physical silver cannot simply be created with a keystroke. It must be discovered, permitted, financed, mined, refined, transported, and manufactured. That process can take years. Yet financial markets often price commodities as though new supply can appear overnight. If you're interested in understanding the forces shaping precious metals and the global economy, consider subscribing. I post videos like this regularly. Now let's talk about supply, because this is where the story becomes even more interesting. Most people assume that if silver prices rise, mining companies will simply produce more silver. But mining doesn't work that way. Imagine trying to fill a swimming pool while someone keeps turning off the hose. That's the challenge facing the global mining industry. Many of the world's largest silver-producing regions are dealing with rising energy costs, declining ore quality, water shortages, labor disruptions, environmental restrictions, and geopolitical uncertainty. Mexico remains one of the largest silver producers globally, yet policy uncertainty and regulatory pressures have created challenges for future investment. Peru has faced recurring political instability and protests that periodically disrupt mining operations. China, another major producer and refiner, increasingly prioritizes strategic domestic supply chains for critical minerals. Meanwhile, energy costs continue pressuring miners worldwide because mining is fundamentally an energy-intensive business. Diesel fuel powers heavy equipment. Electricity powers crushing and refining operations. Explosives, transportation, and smelting all depend heavily on affordable energy. When energy prices rise, mining costs rise with them. And then there's the issue of ore grades. Over time, miners often extract the highest quality deposits first. What remains becomes more expensive and difficult to produce. That means companies must process more rock to extract the same amount of metal. In some cases, silver production is also tied to lead, zinc, copper, or gold mining rather than standalone silver mines. So even if silver demand rises dramatically, supply cannot always respond quickly because silver output depends partly on production decisions for entirely different metals. This creates a structural rigidity many investors underestimate. At the same time, major new discoveries have become increasingly rare. The easy deposits were found decades ago. Today's projects often require billions in upfront capital and many years of permitting before production even begins. In other words, the world may be entering a period where demand growth collides with supply constraints in ways the market has not fully priced in. And then we arrive at demand. This may be the most important part of the entire story, because silver is no longer just a defensive monetary asset. It is becoming an essential industrial input for the modern economy itself. Solar panels require silver paste to conduct electricity efficiently. Electric vehicles use significantly more silver than traditional internal combustion vehicles because of advanced electronics and electrical systems. 5G infrastructure, semiconductors, medical devices, aerospace systems, defense technology, and AI-driven data infrastructure all depend on silver in some form. The world's push toward electrification is effectively becoming a long-term structural demand engine for silver. And unlike some industrial materials, silver has unique physical properties that are difficult to substitute economically in many applications. That matters enormously, because when demand rises for something with limited substitution and constrained supply, markets can tighten very quickly. Here's another important point. Much of the silver used industrially is consumed in tiny amounts across millions of products. That means manufacturers are often less sensitive to silver prices than investors assume. If silver doubles in price, the impact on a smartphone or solar panel may still be relatively small compared to the importance of reliable supply. That dynamic can reduce demand destruction even during price spikes. Meanwhile, governments are increasingly viewing strategic materials through a national security lens. Energy independence, semiconductor manufacturing, defense systems, critical infrastructure, all of these areas intersect with silver demand. And this is why many analysts believe the silver market today looks fundamentally different from previous decades. If this analysis is helping you connect the dots, subscribe and join our growing community here at Precious Metals Alert. History rarely repeats perfectly, but it often rhymes. And silver's history is filled with moments when markets suddenly revalued the importance of hard assets during periods of uncertainty. In the 1970s, inflation surged as oil shocks, loose monetary policy, and geopolitical instability shook confidence in currencies. Gold and silver both experienced historic rallies as investors sought protection from declining purchasing power. Then came the 2008 financial crisis. Central banks responded with unprecedented monetary stimulus and near-zero interest rates. Asset prices soared. Debt levels exploded higher, and trust in traditional financial systems weakened for many investors. During the COVID era, supply chains fractured across the world, factories shut down, shipping bottlenecks emerged, governments unleashed massive fiscal stimulus programs, and inflation returned more aggressively than many policymakers initially expected. At the same time, retail investors witnessed events like the silver squeeze movement, where attention briefly focused on the disconnect between paper silver markets and physical supply availability. Now, whether one agrees with every argument made during that period or not, the event revealed something important. People were beginning to question the structure of financial markets themselves. And underneath all of these historical episodes lies a common theme. Periods of monetary instability often increase interest in tangible assets, especially assets with long histories as stores of value. Because fiat currencies change, governments change, political systems evolve, but hard assets remain. That doesn't mean precious metals move in straight lines upward. Far from it. Silver in particular is historically volatile, but volatility cuts both ways, and historically, silver has often experienced explosive repricing periods after long stretches of neglect. That's why experienced resource investors pay close attention not only to price movements, but to positioning, supply trends, and macroeconomic conditions beneath the surface. Now let's look at why smart money is watching this so closely. Around the world, debt levels have reached extraordinary levels relative to economic output. Governments continue running large deficits, interest expenses are rising, and central banks face a difficult balancing act between supporting growth and controlling inflation. At the same time, geopolitical fragmentation is accelerating. BRICS nations continue discussing alternatives to dollar dependence in trade settlement systems. Central banks globally have been accumulating gold at some of the fastest rates seen in decades. Why? Because gold remains a neutral reserve asset outside direct counterparty risk. And while silver receives less attention at the sovereign level, it often benefits from the same broader trends involving monetary uncertainty and declining confidence in fiat purchasing power. Family offices and institutional investors are also increasingly focused on real assets. Not necessarily because they expect catastrophe tomorrow, but because diversification matters in an increasingly leveraged global system. Think about it this way. If governments respond to slowing growth with more debt creation and monetary expansion, investors naturally begin searching for assets that cannot be printed. That includes precious metals, energy resources, agricultural land, critical minerals, and productive real assets generally. What's fascinating is that silver sits at the intersection of monetary history and industrial necessity. That combination is relatively rare, and it may help explain why some analysts believe silver remains significantly undervalued relative to broader macroeconomic risks. If you're finding value in these deeper macro insights, consider subscribing because we cover the stories mainstream media often overlooks. So what does all of this mean for ordinary people? First, no one can predict the future with certainty. Markets are complex. Prices move in cycles, and silver, like all commodities, can experience large swings both upward and downward. But understanding the forces at work allows people to prepare rather than react. And perhaps the most important lesson here is not about predicting exact prices. It's about understanding purchasing power. For decades, many people assumed traditional savings alone would reliably preserve wealth over time. But inflation changes that equation. Currency debasement changes that equation. Debt expansion changes that equation. This is why throughout history, many individuals preserved portions of wealth in tangible assets, not because they expected collapse, but because diversification provides resilience. Silver and gold historically served as financial insurance during uncertain periods. Productive land provided food, utility, and long-term value. And these assets survived political transitions, wars, monetary resets, and financial crises across thousands of years. Again, that doesn't mean people should make emotional decisions or chase hype cycles. Risk management matters, position sizing matters, patience matters, long-term thinking matters. But the broader lesson is becoming increasingly difficult to ignore. The modern world depends heavily on physical resources while simultaneously operating within a highly leveraged financial system. And when those two realities collide, hard assets often regain importance very quickly. That may ultimately be the deeper story unfolding beneath the silver market today. Not merely speculation, but a reassessment of scarcity, industrial dependence, and monetary trust in a changing world. As we close, remember this. Markets move in cycles. Headlines come and go. But the laws of supply and demand never disappear. And today, silver sits at the intersection of some of the largest forces shaping the global economy: energy transition, artificial intelligence, industrial electrification, geopolitical fragmentation, debt expansion, monetary uncertainty, and declining confidence in long-term fiat purchasing power. At the same time, the mining industry faces rising costs, aging deposits, and years of underinvestment. That imbalance matters. History shows that when critical resources become strategically important during periods of monetary stress, markets can reprice very quickly, not because of hype, but because reality eventually catches up with supply constraints. And perhaps that's why more investors, institutions, and governments are quietly paying closer attention to precious metals once again. Not as relics of the past, but as strategic assets for an increasingly uncertain future. Whether silver reaches $100 or not is ultimately less important than understanding why so many structural forces are now converging around the metal at the same time. Because once people begin recognizing the difference between paper wealth and tangible scarcity, market psychology can change very rapidly. Pay attention to the trends most people ignore, because sometimes the biggest opportunities emerge long before the crowd notices. If you found this analysis valuable, please like the video, subscribe to Precious Metals Alert, and share it with someone who wants to understand the changing world around us. Until next time, stay informed, stay prepared, and keep your eyes on the metals.